If you want to make $1 million a year as a mortgage originator, I'm going to tell you in today's podcast episode, the 5 loan products that you need to W-2 or 1099 7 figures. Ladies and gentlemen, boys and girls, children 18 plus. You are tuned in to Loan Officer Podcast with me, Dustin Owen, and my main man,
JC.
John Coleman.
Yo, what's poppin'?
JC, I'm getting excited for yet another weekend of football, while also kicking off the second week of our Super September.
It's like an advent calendar. Can't wait to open it for the candy, Dustin.
It is just like an advent calendar. So if you're tuning into this, unfortunately, you missed out on the amazing call that Sean Chalice did.
Yep.
He did it for all of the realtors that work with the loan officers and the mortgage brokers that tune into TLOP.
Yep.
And you missed on the amazing call that I did with the mortgage legend himself, Todd Duncan.
Todd D.
However, if you want to see Todd Duncan, you still can. Come out to Dallas, Texas. It's in October. Sales Mastery. I'm going to be there. The TLOP crew is going to be there. It's going to be one of the biggest mortgage events of the year. And Todd's going to be headlining the event because Sales Mastery is his event. He's been doing it for 20 plus years.
There you go.
Yeah, but.
Shout out today's show sponsor.
All right. We love the broker community so much that we can't wait to go to the Fuse event powered by AIM this October in Nashville. And we want you to join us there. October 23rd through 25th. The venue, the Gaylord Palms Hotel. You are not going to want to miss this event. A, because Nashville is one of my favorite cities. But B, because Fuse, powered by AIM, is one of the biggest and best broker-centric events of the year. We're talking about learning from and seeing guys like Matt Ishbia, Renee Rodriguez, Neil Dingra, Barry Habib, plus dozens of top producers and dozens of marketing experts all looking to pour their experience and their knowledge into you. For more information, make sure you go to the website. The website is fuse.aimgroup.com. And if you're looking for a discount, be sure to use the code TLOP50. That's TLOP50. And you can save money on your registration. Become an AIM premium member, and you'll notice that your membership includes a free ticket to this year's Fuse event. So I teased today's episode with stating these are the 5 loan programs you need to make $1 million.
I already know what they are.
Do you?
A jumbo loan, a CP loan, an FHA loan, a USDA loan, and a conventional 30-year fixed.
Okay.
If you're interested in learning more, head over to the website, tloponline.com. But that's all the time we have for you today. We look forward to catching you on the next episode. Peace.
Probably not that easy. Oh, my God. Probably not that easy, John.
How far off was I, Professor?
I mean, you probably would have gotten a D.
So I would have passed.
You probably would have gotten a D minus.
Shit.
Yeah. Okay. So you gave me an answer, but you didn't show your work. Yeah. I need to see the work, John.
Come on, Doc.
And I'm not putting CP in there, and I'm not putting USDA in there.
Oh, but jumbo you might.
Jumbo, I will.
Okay, let's talk.
I will put jumbo
What's
in
wrong
there.
with construction to perm loans,
There's
Dust?
nothing wrong with it, but I don't need that loan to make $1 million a year.
But it's a sexy product, and I can go to builders and be like, look at how I can help you sell more homes and make more money.
Sure, you 100% can. If that's you, fly your freak flag. Fly it. But I'm saying you don't need that loan program to make $1 million as a mortgage broker or a mortgage
What about one of those
originator.
exotic products where it's like no down payment, 412 credit score, I'll get you approved? No?
No, look, here's the deal. You do need some kind of a down payment assistance loan. You do. I don't think you need the super portfolio that only one credit union in all of the Southeast or the Northeast or the Midwest has this to do so. In fact, I don't coach or advise people to go chasing niche products, because my problem with niche products for the past 20 years is they're phenomenal until they're not. And by they're phenomenal until they're not, what I mean by this is you can go work for a bank or a credit union that loves that product until they get their fill. And if you built your entire book of business around that one product and it gets taken away, you are SOL.
Give me an example of such product that you've experienced in your tenure as a mortgage loan originator.
I have witnessed mortgage originators who were 80, 90% doctor loan at a certain depository institution. And they crushed it 3 years, 5 years, 7 years, until all of a sudden that bank was acquired. And when they were acquired, this new bank doesn't want to offer that product. Or the bank, this is a true story, during a market turn down, the bank says, we don't want to do any of these loans unless we have actual brick and mortar banking locations in that market. And this top producer was in a state that he was doing a ton of mortgages, but there weren't a lot of brick and mortar. And all of a sudden you are literally rug pulled from underneath your feet and you're out chasing the next company that's going to offer you that niche product. Now, am I anti doctor loans? Hell no. If you got a doctor loan and it kicks ass, sell that mug. Like literally go out and sell it. I just don't know if I would ever allow for it to be 80, 90% of my business. And by the way, just like anything that we talk about on this show, I'm talking patterns. I'm talking what's scalable. I'm talking what's predictable. I'm not talking about the outliers. Well, I know a guy, I know a girl. We all have those stories, right? I know someone who did X, but do you know a lot of people who did X?
No.
Okay. Well, you know a lot of people who did X. Yes, John.
Well played, Dad.
You and your entire friend group and everyone you went to college
with. You got your goal points for that one.
Yeah,
you still got it.
Okay. Dad joke of the week.
Yeah.
No, but it's like, I don't need that. Like, I don't need y'all hopping in the comments on YouTube like, oh, I know this guy that, you're full of shit, Dio. Here's what I'm saying. And I'm not saying I'm not full of shit. But what I'm saying is that if I put 100 people in a room that have their NMLS number, that do loans for a living, and they all make $1 million a year, I am confident that 80 out of the 100 all fit the same mold. And then you have 20 of those 100 that are somewhere between a absolute outlier or typically they're a hybrid of the other 80.
And then we parade those people on stages and breakout groups and have them teach us how they can accomplish the same when they know they can't.
Yeah, so what I want to do is I want to take the 5 that defy, and I always use this example of the guys that I work with that use mailers. I mean, this is the number one branch at Lower.
This is incredible.
These guys crush it. But they have a business model that I wouldn't coach or teach because I don't think it's scalable. Yet for them, we talk about them all the time because they're outliers, right? Like I got a buddy of mine, shout out to Ian MacDonald. He kills it in his market. And he is 80% CP. You talked about CP. Yeah. Ian Mac kills it. I don't know how replicatable that is. There are plenty of originators that dominate that doctor loan. And it's 80% of what they do, and they kill it. But guess what? They work at a bank or a financial institution where there are 20, 30, even 100 of them, and only a handful are killing it with the doctor loan, right? Because not everyone can have access to that loan. Not everyone is going to be able to get their foot in the door with the right referral sources. So those tend to be outliers. So today's podcast episode is more about, what 5 loan products do I need? And it's my gentle reminder of letting people know that we have products that sizzle, and we have products that are substance. Products that sizzle is everything you have access to. It sizzles. If it can spark an interest, if it can get a borrower to call you back, a realtor to meet with you, then sell the crap out of that sizzle. But then there's products with substance. And substance is, in reality, what loan program or product am I really going to use in order to fund this loan? And those are the loan programs or products that I really have to have access to. And then lastly, before we get too deep into this, because what I'm trying to do is dispel any naysayers, any trolls out there like, okay, guys, I understand you, but I want you to listen to me because what you're saying isn't replicatable. It's not scalable. I want y'all to know that just about every lender that I'm aware of has access to thousands of different loans, right? It is not unique to my friends in the broker community. It is not unique to my friends that work for IMBs. Now, if you work for a credit union, maybe it would be unique, but I know a lot of good credit unions and they have access to a lot of different products. So having access to a lot of products is nice, but in reality, we don't need all those products to actually do our job. And that's what today's episode is going to be. So here are the 5 are, John. So you guessed conventional. You guessed jumbo.
Survey says.
Well, you got 2 right. Did you guess FHA?
Yeah, I did say FHA.
You said FHA. Okay, cool. So here they are in order.
Okay, of most important?
Now, of those that you will actually originate the most of.
Okay.
FHA is number 1. No. What?
Damn it, Dustin.
Conventional is number 1. How did I just do that?
I don't know.
Conventional is number 1. In most markets, FHA is number 2. VA is number 3, but those two can be flip-flopped. Then you need some kind of a standard down payment assistance loan.
DPA.
Yep, DPA. I love the state housing agencies, although we've had Hoper on here, and there's others that are just like it. I think Click and Close has a pretty decent down payment assistance program. And then you need your standard jumbo. Your standard jumbo. Now, look, there are credit unions out there that have amazing jumbo. 5-year ARMs, 90 LTVs, super aggressive pricing. No. That's great for those originators and great for those credit unions. But if I were to put 100 mortgage millionaires in a room, I know that 80 out of the 100, those 5 products are the 5 that they originate the most of. Now, I'm not saying they don't also do bank statement loans. I'm not saying that they don't also do DSCR loans. I'm not saying that they don't potentially do a renovation loan. I'm not saying that they don't do them. What I'm saying is that you don't need those loan programs to make $1 million in this industry. You just don't. You need those 5. And then you need to be damn good at those 5. And you need to be even more damn gooder at actually generating leads, at actually building relationships with referral sources, with actually marketing to your database, with actually physically being present at networking functions. Like, that's where you need to be elite. You having 10 different loans that you offer and 10 different loans that you're trying to be perfect at and having 10 leads a month is not scalable.
So why wouldn't all loan officers just focus on the bread and butter, like layup loans, like conventional and all the other letters you just threw out?
Because we're all looking for Ozempic. We're all looking for that shot, that pill, that quick fix. Yes. Nobody wants to do what needs to get done. What needs to get done is show up to work every day. What needs to get done is prioritize your activities to focus on networking, sales, marketing, lead conversion, lead generation. Like, nobody wants to do that. So they're always looking for the easy way. And I have met so many newly licensed originators. They're like, well, I'm going to focus on non-QM because everyone else is focusing on conventional FHA and VA. I'm like, look, knock yourself out. But when I study the pool of home buyers, and yes, non-QM is growing, and yes, we love our non-QM products, non-QM still makes up less than 20% of every loan being originated. 80% of the loans being originated are conventional FHA, VA, your standard state bond down payment assistance, or some kind of a generic jumbo. And like in my career, John, I did maybe 6 jumbo loans out of 1,200 loans I ever did. And maybe 6 is an understatement, but it was such a small amount, right? I lived in Orlando, Florida. I didn't specialize in luxury markets. Now, I never worked for a lender that had like super aggressive pricing on those jumbo loans. And I didn't market to realtors that sold luxury homes. But I needed 4 conventional FHA, VA, love my VA, and that Florida bond. Doing those 4 loans, all I needed to do. In fact, you bring me a renovation loan, I punted it. I gave it to the young kid in the office.
Where's that?
I'll let him suck up 4 or 5 hours of his time trying to figure out a hard ass loan, right? Because that was 4 or 5 hours that I could have spent marketing. I could have spent going to a networking function. I could have spent following up with leads. I could have spent scheduling appointments. I'm not going to do enough renovation loans that I needed to be the expert. Now, that said, there are plenty of people who entered into this industry and they said, I'll be the Reno King, right? We had one on the show. Shout out to Joe Manglardi, right? Now, is he the Reno King today? No. That's what he did early on in his career, but he realized quickly, and Joe didn't tell me this, I'm just, putting 2 and 2 together. If he wanted to do a lot of loans, he'd have to do a lot of loans, focus on the loans that were being done the most of. Most home buyers, conventional, FHA, VA, your standard down payment assistance, typically a state housing authority type loan, and a standard 15 to 25% down jumbo loan.
What's the easiest loan product to originate and what's the most difficult?
That's a loaded question. Like, that is a loaded question, because if I get a DSCR loan where the appraisal comes in like beautiful, one could argue, I'm not qualifying income on this loan program. One could argue that's a pretty easy loan to do. The problem with DSCR loans is that there tend to be other moving parts and low appraisals. And not appraisals in terms of like the value coming in low, but the rent coming in lower than I needed it to in order to get the loan approved. Like, someone could argue, conventional 25% down. Sure. Like, theoretically, if I have a 25% down conventional loan where I get a PIW, where I utilize the work number for my income validation, when I'm using, a service like Blend and I'm getting asset verification, theoretically I can do a conventional loan and never have to get a pay stub, a bank statement, or an appraisal. Theoretically. Mm-hmm. But I've done plenty of VA loans for somebody who is W-2'd, salaried, and have a 680 credit score. They're putting no money down. They have just enough money to cover their closing costs, but the residual income is 120% of what's required. And that's a super easy loan to get through. And FHA is not hard either, right? I think you have hard borrowers. I think you have difficult properties. You have seller and title issues, right? Anytime you have a borrower who has multiple jobs and they're hourly, it becomes a more difficult file. Anytime you have gift funds involved, you have more moving parts. Like, there's definitely things that come along that make it moving parts, but I don't think one loan program or product is more difficult. Now, personally, I don't like bank statement loans, but they become a lot easier today utilizing technology, but you're having to annualize 12 months of bank statements where you're like calculating all the deposits in order to come up with an income. Mm-hmm. So they can sometimes be a little bit trying. Why I don't like renovation lending and why I don't like CP loans for myself is that I'm married to that loan file for a much longer period of time. So now I'm adding in even more components, whether it's a consultant, an advisor, a contractor, draw schedules. But I have friends that freaking love the CP loan. Like, they love them. They love them because they like working with builders. They like builder referrals. They think those leads convert at a higher percentage. Their average loan size is $100,000 more on a construction loan than it is on a resale. So for that reason, they may love a construction loan. But me personally, I don't find one product of the 5 that I mentioned any more or any less difficult, because I think that comes down to the actual transaction, which includes the property, includes the seller, includes both agents, includes the title work, but also the borrowers, because we definitely have borrowers that are messier and borrowers that are not. Realtors get this wrong. They're like, this person has 800 credit and $1 million in the bank, and they're putting 50% down. This is going to be an easy loan. Until they're self-employed, they have 5K1s, they have, Schedule C income, they have all of these business write-offs, and all of a sudden, what the realtor thought was easy because there's an 800 credit score and $1 million in the bank, I have a file on my desk that looks like freaking the Encyclopedia Britannica. And I'm like, where's that FHA borrower with the 620 credit score?
Yeah.
Because and mom and dad are gifting funds to close.
Oh, right, yeah.
I would take that all day long, especially if it's one borrower and they're salaried and their income is super easy to document and prove. And I have an AUS approval.
Yeah.
So I wouldn't say one over the other, but I will say, and I'm going to circle back to the topic or the theme of today's show, that I do think too many originators get too cute and too creative because they're afraid of the hard work. Therefore, they're looking for the easy way out. And I remind them all, if it was that easy, we all would be going that direction. Now, I have a guy that works with me over at Lower, and I met him because he coached with me like 3 years ago. The guy's name is Adam. Adam's business is 90% investor business. He is Mr. DSCR. He is Mr. Non-QM. Now, that's all Adam knows. It's how he was brought into the industry. So he was brought into the industry working specifically for a shop that focused on investors doing these loans. Adam's the exact opposite of what I teach, but he's so much the same. You know what Adam's right now not doing? He doesn't want to do FHA purchases. He doesn't want to do down payment assistance. So we're working with Adam, hiring an inside loan officer to work on his team so that Adam can still do the things that he loves to do, which is lead generate, run a branch, make a bunch of money, help a bunch of people. But Adam still wants to sink in with his bread and butter, which is the investor community. But I would tell people what Adam does when I put 100 people in a room, there may be 3 Adams, 3 of the 100. So although it works great for Adam, and I know exactly how to coach him, exactly how to help him build out his team, create his infrastructure, document his systems, understand his numbers, because Adam's numbers are going to vary compared to, let's say, Patrick and Kevin's numbers, because his business model is a little bit different. I don't go around the country teaching Adam's way. And I would tell someone, if you want to learn Adam's way, go work for Adam. But that's not the most scalable. I'm teaching you how to be dominant and how to be successful regardless of what market you're in and regardless of what the market is doing. So market you're in, regardless if you're in Chicago, Seattle, Atlanta, Annapolis, Dallas, or Orlando, right? That's regardless of your market that you're physically in, but also what market are we in? Is this a market like 2016? Is it a market like 2018? Is it a market like 2021? Or a market like 2024? Well, in those markets, if you focus on these 5 products and you do them really well, you don't need other products. It doesn't mean that you don't have access to them. It doesn't mean that you don't promote them. I mean, shit, I used to go around and I literally would tell realtors in Orlando, Florida, whether it's a $40,000 USDA condo or it's a loan for a professional athlete, please know I have a solution. And I did. What I didn't tell them is I might not be the loan officer on that particular borrower. I may actually partner with a teammate and have my teammate actually take that loan because I have no desire to do a loan that I'm not good at. I have no desire to learn a loan that I'm not going to be doing 1 or 2 a month every single month for the rest of my career. And I have learned that if I have X amount of hours in a day, and X amount of hours in a week, and X amount of hours in a year, I want to focus those hours doing the things that I like to do, that I'm good at, that have the highest yielding results, which is typically generating the most leads for the type of borrowers that are going to need the product that is the most readily available and the most used. And I want to be great at that. And then when something comes my way that doesn't fit into my skill set, I can then triage it and figure out where does it go. Do I refer it to my friend down the road that works for the competition and saddle him or her with this headache? Or do I give it to someone inside of my office where they do the bulk of the work, I handle the communication, yet they can be saddled with the time, that commitment it takes to do that loan, where I still get half commission, but I get all of my time back to go do the things that I want to do. And that's what I don't think enough originators really think about. And look, if you want to disagree, but my data is spot on. Like my data of, I know the most top producers of most people. I know the most mortgage millionaires. I have studied them. I've had them on this show. They have become my friends. These are the patterns that we all should be following. And I would hate to see somebody ever raise their hand and say, oh, I wish I knew better. Well, today was your chance to know better. Oh, I wish someone told me. Well, today someone's telling you this is all you need. And by all means, if you want to never do a jumbo loan because you're doing CP loans, awesome. Slide that into the 5th position. If you want to never do down payment assistance, but you're going to do a ton of DSCR loans, by all means, slide that into the 4th position, right? Like I gave you the 5 that I have studied and that keep coming up, right? But the top 3 are the top 3. Conventional FHA, VA, 1, 2, 3. I'm going to tell you down payment assistance, think state housing authority, and then I'm going to tell you your standard jumbo. However, if you want to slide out the 4 slot or slide out the 5 slot, feel free, but please know you really only need 5 loan products in order for you to make $1 million plus a year as a mortgage loan originator.
That's a quality episode for completely winging it on the second subject. So kudos, Dustin.
Yeah, well, I mean, it's not really winging it. This comes up all the time in our coaching dialogue. Like we have 4 ways, John. I don't know if you know this. We have 4 ways people can come coach with us.
Okay.
Yeah. So the top way is elite, but we only let 24 people in elite every single year. That's when you are getting one-on-one coaching. Like it's a designated TLOP coach, and you're meeting every other week for an hour. Plus you have access to everything that TLOP offers. So that's elite. Now our most basic way to join, that's come and be a part of the TLOP coaching community. That's where for a small annual fee, like literally less money than you probably make closing just one loan a year. Like one loan a year pays for your entire membership, but we're going to give you 8 live coaching calls every single month. We have a coach on duty every Monday, Wednesday, Friday. That's when you can get one-on-one time with one of the TLOP coaches for 10 or 15 minutes. Like that's your opportunity to get that hard-pressed question answered. Then in the middle, we had this boot camp that I started 3 years ago. It's my signature. It's called Launch. Whenever you hear me talk about Ben in Boston, Amanda in Alaska, how Lindsay went from 1 million to 3 million, and now she runs her own branch, or how Sarah increased her income by 50% in literally less than a year, they all graduated from the Launch boot camp. The thing about Launch, it's not for everybody, and we only let 10 people in every month. We start a new boot camp every month, but only 10 people are allowed in. Boot camps last 16 weeks, 12 calls over 16 weeks. So that's a way. And then we have this new product that we're calling Community Plus. And this really came about because our coaches were telling us that they're hearing from the members that they want something that's a little bit more accountability than what they get by the community, but they're not quite ready for elite. So I was like, cool, let's do Community Plus. It gives them everything that they get in the community. However, now they're going to be assigned to a small group of them and just 4 others that are going to meet every other week with their assigned coach. So their assigned coach and their small group will hold them accountable. They'll get some private time with a coach, but they're not yet making that commitment to go elite. So those are the 4 ways. We have community, we have Community Plus, we have elite, and for those that it makes sense, we have the Launch boot camp. So John, I wasn't winging it because I coach this every day, every week, every year, and I have for the past 3+ years under TLOP, but I have as a producing branch manager, producing area manager, divisional sales executive for the past 15 years, whether I was at Waterstone or I was at Lower.
Fascinating stuff, Dustin.
You seem fascinated, John.
I almost want to sign up for coaching.
Could you imagine you as a student?
No, because I'd listen to a coach and be like, what the hell are you talking about? Leave me alone. Let me see your homework.
I would be thrilled if I could get you to start attending mastermind sessions. Not with loan officers,
I know,
with content creators.
Get out of here.
Yeah, exactly. All right, let's do this. Let's find a way to put a bow on today's episode.
You can.
You want me to do it?
No, because they're going to go back over the pricing again. All you have to say is, he's John Coleman. I'm Dustin Owen. That's all the time we have for you today. But we look forward to catching you on the next episode.
Everything he said, but I'm going to throw in this. If y'all want to connect with me, first name Dustin, last name Owen. I am on LinkedIn. It is the #1 way to connect with me, mano y mano. I would love for you to follow us on Instagram at The Loan Officer Podcast. If you are tuning in on Spotify and Apple, we say thank you. Please make sure you give us a 5-star review. By giving us a 5-star review, you are letting others find out that this content exists. Thinking about others, why don't you go ahead and share this content with at least 2 other people that either you work with or that work in the mortgage industry if you feel like they would benefit from today's episode. And if you're watching us on YouTube, thank you so much. YouTube's my favorite platform. Please make sure you click subscribe. That way you'll get notified every time JC drops a new video. And when you're subscribed on YouTube, it's your only way to get free sales coaching and free sales training once a week through a special drop that we have every Wednesday. So sharing is caring. Don't keep us a secret. Go to our website, tloponline.com. Sign up for my newsletter. Newsletters is how you stay up to speed with every free event that we're doing. It's where you'll know where we'll be next. And it's another way that you can continue to be a part of the TLOP community. He's John Coleman. I'm Dustin Owen. That's all the time we have for you today. We do look forward to catching you on the next episode. Peace.